welcome back to MMGinvest. First of all, I'm not your licensed financial advisor. Consult your licensed financial advisor before doing anything. Equities, stocks, extremely volatile, extremely risky. Do not invest anything you're not willing to lose or lose sleep over. I really mean that. Have stops in place, emotions out, and in this video, I'm going to try to cover all the news and the craziness going on in today's globalized economic system. So, I'm going to go over charts, but first I'm just going to give you guys my opinions and rants on the current news cycle, right? Because it's pretty wild. So, what do we have? Of course, everyone knows now. I will cover, for the crypto people, I will cover the Powell, or no, not the Powell, the Jade Clayton, and also, this was last week's news. Mark Carney was talking about a global crypto to replace the dollar. I'll talk about that in my separate crypto video. But for now, let's talk about the stock market and equities, the economy, precious metals, and all that, right? So, I don't know. Nobody knows. Nobody's sure who really attacked the Saudis. And what is the real extent of the damage? There is one thing I do know, though. That the war drums, the war hawks, they're really beating. Let me show you guys. Give me a second. I did post it in the free newsroom. Links below the video. Here we go. So, we have Raytheon and also Lockheed Martin, right? These are the U.S., the drones and all the aerial and surveillance. These stocks, they really take off during wars and prior to wars. There are insiders, right? And here's what's interesting. Raytheon and Lockheed have been rallying. Okay, so Raytheon's on the left, Lockheed's on the right. This is a 4-hour chart of Raytheon. Raytheon broke out on the oil news, right? On the attacks. And then Lockheed's been rallying since the beginning of 2019, this year. Now, why is that? Apparently, some insiders, some whales, some who knows, right? They know something's coming. And that's the only thing I could think of, right? Why else would this war stock rally from the beginning of this year when nothing's happened yet? Nothing serious. So this is something to look out for. And obviously, I mean, I've been listening to CNBC, and it's one after another talking head, energy CEO coming out and saying, we need to take out Iran, and I don't want to get into why this is happening in the sandbox. It's been happening for a while now, right? Over a decade. That's for other videos, and I can't post those videos. But obviously the Saudis and their oil used to back the dollar, the petrodollar, right? But not so much anymore, though. Here's the thing. What happened was, over the weekend, this happened over the weekend, right? And I sort of anticipated something might happen over the weekend. Things always happen over the weekend because it catches everyone off guard. The insiders buy prior to the weekend or during the weekend because they can. Some institutions can buy while you can't over the weekend. But big things always happen over the weekend, especially when it comes to defense. Here's oil. All right. So oil gapped up on Monday morning, right? It shot up. It was the largest rally ever since like 1991. And now it's sold off. It was a knee-jerk reaction. And that's because the market is starting to sense that there's a lot of bullshit in there. Like, the Saudis are saying, well, production will be back in 3 weeks, 3 months. The news, the news hypes everything. Listen, for the U.S. at least, it's only like 5% of oil. Well, no, not for the U.S. For the world, it's not as much as it used to be. The Saudis are just not as much. It's probably more than 5%. It's probably 15 or 20. But for the U.S. alone, it's only 5% or something. So, but prices are probably going to take off anyways for oil. It's just, they're going to take advantage of it at the pumps. But honestly, this is not so much about oil. This is more, I believe, about, the sandbox and putting in strategic people in power in the sandbox. And I have to be careful of what I say, the words, so my video actually gets some traction. This has been going on, right, for over a decade now. So obviously certain countries and people are getting taken out, and then they put in people that are controlled, this and that. That's what I see. That's what I think. Obviously, it's above my pay grade. Either way, nobody knows who really attacked. That's the thing. In this world today, you don't know what to believe anymore. Honestly, I do care, but I don't. Let's just say I don't care for this video. We're just trying to figure out what does this mean for the economy and the markets, right? So I do post articles though in the newsroom. Of course, this is going to delay the Saudi Aramco IPO. And, this has been delayed for like 2 years now. It's the biggest IPO. Now, the question of how much, is there a peak oil? Is there enough oil in the world? I think there's plenty of oil. Because there's plenty of second and third world oil reserves that haven't been tapped into. Not just that, Iran has, I think, more than the Saudis now. So that's another thing, right? Did the Saudis attack their own fields? It's just giving them excuses to go in and take out their competitors. That's another thing that, I think about. But it's all speculation, right? What I'm more concerned about, what does this mean for the global economy and the markets? Well, right now, the only thing I'm taking into consideration is this is a push for war. War creates uncertainty. Uncertainty creates an opportunity for precious metals and safe haven assets, utilities and commodities. Although in the past we've also seen the stock market rally during wartime. It's actually pretty interesting. What does it mean for bonds? It's actually net positive for bonds, and it's going to be interesting because the central banks have to keep interest rates low, but the demand for bonds is going to go up. So that I'll talk more about that later. Let's just keep let's just stick to the news right now. I just want to go do a brief run through. So another JP Morgan precious metals trader was caught and prosecuted, and they've been manipulating it for like over a decade. And remember how everyone was called a tinfoil hat person for saying that the metals markets were manipulated? Well, they have been. Like every major bank has been caught in the past year, in past few years doing it. So, which is funny. It's actually I'm surprised that the regulators are going after them, because I kind of tend to think that they're all kind of working together. Maybe they're just what they're doing is they're letting the precious metal markets loose now, because they go long too, and if they're long in precious metals, hey, that's great. So 53.2 billion in QE light. Fed concludes first repo in a decade as a liquidity panic ensues. So the repo market, this is fascinating. We haven't seen this since 2008. The money market funds, right, and all the debt, pretty much for loans, money ran out over the weekend. So banks can't give out loans. And this is a little more advanced. I don't really want to go into it, but you guys could read this. Basically, the Fed was forced to print money over the weekend, and a lot of it. It's over after a torrid 30 minutes in which the New York Fed first announced a repo operation, then announced the repo was canceled due to technical difficulties. Then the difficulties went away just minutes later. At precisely at 10 a.m., the Fed concluded its first repo operation in a decade, which, while not topping out the 75 billion max, was nonetheless significant. 53.15 billion split as follows. 53 billion is a lot. That's a lot of just money injected into the repo market here. So, while the Fed did not disclose how many banks participated in the operation, it is safe to say it was a sizable number, worse than the results from today's unexpected repo operation. We can now conclude that in addition to 1.3 trillion in excess reserves, a Fed which is now cutting rates and will cut rates by 25 basis points tomorrow, and that is tomorrow. Tonight is it's Tuesday night, 9 p.m. U.S. Eastern Standard Time. The U.S. financial system somehow found itself with a liquidity shortfall of 53 billion that almost paralyzed the interbank funding market. So this is the interbanking funding rate. Well, not rate, but these banks, they transfer money back and forth to one another, and they lend money to each other nonstop. That's the interbanking lending rate. And the interbanking lending rate is the fractional reserve rate, and that's what the Fed, the central bank's target. All of a sudden, they ran out of money. And they ran out of money because they raised interest rates in 2018, and now the chickens are coming home to roost. And, this we saw this in 2008, at the beginning, before the recession. So, I think this news alone really rattled the markets today. And what I think is going to happen is this will be brought up during the Fed minutes tomorrow, and this might also force Powell's hand, the Fed's hand, to cut rates 50 basis points. More than 25. 25 is already baked into the cake. So the stock market's been rallying for the past 2 weeks, 3 weeks. Those cuts are already baked in. The 25 basis points is already baked into the recent rise in equities. I think they're going to cut 50. And I've been saying this for weeks now. No one's been saying 50 for weeks. But the reason I said 50 is because if you understand the macro aspect, they have to, the money and the liquidity that has to go back into the market to keep it from falling and to keep it going up has to increase over time. Compounded. It literally has to constantly increase. All right. So let me continue. Let me finish this. Oh, and for those wondering, the Fed did a repo. The answer is simple. It did not want to launch QE just yet. But make no mistake, once repo is insufficient, the Fed will have no choice but to escalate the next step, which is open market purchases. Which brings us to the bigger question of how long such overnight repos will satisfy the market and how long before the next repo rate spike prompts the Fed to do the inevitable and restart QE. All right, like I just said, at some point, the liquidity is going to dry up and the banks can't lend out money. Once lending stops, I mean the party stops, the music stops, and you're gonna see a huge liquidity crunch, right? You get a liquidity crisis, and the only way to stop that is they have to print money. Super bullish for metals. All right. And this is important, and I think because of this alone, the Fed will cut rates tomorrow, 50 basis points, and I think it's going to send metals higher. Also, I actually found another indicator, which actually I've used in the past, but nobody talks about this and uses this to trade metals, and I'll talk about it briefly, but I don't want too many people using it because it's really good. All right, so let's continue with some of this news then. U.S. manufacturing recession continues for second month in a row. So manufacturing is continuing to deteriorate. Trade war is not really helping with that. Although the point of the trade war is to get manufacturing back to the U.S., but you have to understand, like 3 decades of manufacturing leaving the U.S., it's not going to get fixed overnight. And I honestly don't even know how Trump's going to fix it. This is the scariest part of the entire reset and economic, collapse that's coming. This is the scariest part. There's no manufacturing in the U.S. That's what scares me the most. It's not all the debt. The debt is, it's just someone else's wealth, and it'll get wiped out. I don't care about that. What I care about is manufacturing, jobs. Because if people don't have jobs, people get angry. This is a hilarious meme. Just soak that in. It's hilarious. All right. I'm not going to read all that. So we're going to take a look at the bond market for a second. So another economist, Lawrence Kotloff, did a bunch of, some fancy schmancy Ivy League math, this and that. And they have concluded that the U.S. debt is $222 trillion. And that's including everything. And, I've said that. Everyone talks about the freaking 19, 20 trillion. There's this debt clock in New York City on one of those buildings. I've seen it. And it reminds everyone how screwed you are. But that's nothing. That's absolutely nothing. And that's like the only debt everyone looks at. That's nothing, guys. All the unfunded pensions and liabilities, all the free shit, that the Dem candidates are promising. Well, it's already at $222 trillion. The U.S. economy year over year is around $20 trillion, give or take 5. I wouldn't even give. I'd only take. So I would say the U.S. economy, without all this money printing and debt, is like $8 trillion a year. Well, its debt is at 222, and this is going to explode during the next reset, right? Financial reset, global reset, U.S. reset, whatever it's going to be called, right? This is going to explode. It'll be absolutely unmanageable, and you're going to be seeing like $2 trillion deficits year over year, and that's like scary. I mean, I don't. The world's never seen anything like this. The amount of debt. All right. So Just another bullish case for metals. Breaking news that the rate cut odds are going up. Let's see if I missed anything. Check out this chart. I agree with this. This isn't financial advice, but when it comes to risk, this upside down pyramid with everything in it, I highly agree with it. So at the top is derivatives, unfunded government liabilities. That's at the very top. It's at 1.2 quadrillion. And government liabilities is at 210 trillion or somewhere around there. Non-monetary commodities, 5 trillion per year. Private business, 100 trillion. Real estate is 217 trillion. Corporate bonds, securitized debt, listed stocks, and then it comes down to government bonds and treasuries, and then paper money. And the least risky is gold. So imagine all of the money. Here's the wealth transfer visualized, guys. I can't draw on this right now. But just imagine all of the money from the top of the pyramid transferring to the bottom. And that's what I'm hoping for and what I want to capitalize off of. We're looking at possibly the largest wealth transfer in human history. And listen, guys, the party hasn't even begun yet. It hasn't even begun for gold and silver. Believe me, most people are not in it. Most people aren't even looking at it. They're starting to just get nervous maybe. But we're still looking at a possible stock market melt up. And metals are going to melt up with it. Also, I have to announce, listen, because some people have short attention spans, I only watch half my videos. That's why they're never going to be successful. And I'm going to make a video, very important video. After this video, I'll post it tomorrow or something like that, sometime this week. Is precious metals going to crash with the stock market? Because it did do that in 2008. So I'm going to make a video on that because it's very important. Because a lot of people are going to panic. A lot of people use it as a buying opportunity. You know, you don't want to be holding any leveraged ETFs or anything like that if that does happen in case that does happen. Or maybe it might not even happen and the metals just shoot up and the markets fall with the bond. I'm going to talk about it, theorize about it, because nobody really knows how it's going to play out. Because nothing ever plays out exactly like it did prior in the past. All right. And then I'm going to make another video, which I've been dying to make. It's just I'm so busy. Strategy, portfolio allocation. Here's Ray Dalio's all-weather fund. I'm going to talk about this. And then I'm going to talk about how I am personally doing things, because extraordinary times call for extraordinary measures, and you're going to have to do things differently from what most people think you should be doing. You want to separate yourself from the herd, all right? Because what markets do is they wreck the majority of people. So, it's game theory. I'm going to theorize about it. It's going to be a good video. So let's look at the markets. Let's go into the charts. All right. So volatility is pretty low right now, right? And the S&P 500 near all-time highs. Same with the Dow. Same with the NASDAQ. Gold rebounded and bounced very nicely. The dollar's up 98.6. It's very strong right now versus the other fiat currencies around the world. It's not strong against gold and silver. It's actually losing value against gold and silver. Now, remember, guys, gold and silver is at all-time highs globally against other fiat currencies like the yen, yuan, Australian Aussie, the euro, the pound, right? So just keep that in mind. That's important. And I'm going to talk about my new indicator. Something I found that no one talks about. Well, not that I don't know. Maybe other people do talk about this, other traders, but I haven't seen anyone. But it's very reliable to time the dips, the corrections, and the rallies in gold and silver. So I'm excited about that. All right. So let's start looking at the stock market and all that. The NASDAQ, here, the daily for the NASDAQ. That 9 sell, it did play out because it did drop Monday, the markets, but it's rebounding now. So I was hoping that the market would sell off more prior to the Fed minutes and the FOMC, but apparently the markets aren't worried. They think they're going to cut. I guess that's what the market's saying. They're going to cut more than anyone expects because the market's confident. If it wasn't confident, it would be selling off. And then, in a way, though, that would force the Fed to actually cut more than they want to. So it's tricky, right? Now, if the Fed only cuts 25 basis points, I expect the market to drop. If they only cut 25 basis points, maybe metals will drop too. So tomorrow's a big day. This is the NASDAQ, by the way. The daily chart in the NASDAQ index. So the market's confident. Now, here's what I'm thinking. If they do cut 50 basis points, we're going to hit all-time highs next week or tomorrow. Well, maybe not tomorrow. Maybe, I don't know. But this week, we will hit all-time highs if they cut 50 basis points on all the indexes. And that'll also shoot gold and silver higher for the short to intermediate term. All right. Let's take a look at the Russell as well. See what that looks like. Yeah, the Russell looks like it wants to break out to the high to the upside here. It's been holding up pretty well outside of this descending triangle never actually happened. Delete that. So the markets are expecting a 50-point cut. I mean, they look like they want to go higher. So this is the melt up that I warned you guys about since the beginning of this year, that I wasn't sure what we will get. We'll either get a melt up or a huge correction, right? Looks like we're going to get a melt up. Here's the FANG stocks. You know, they dipped. There was a 9 sell. By the way, for the private members, you guys get my indicators, just so you know. But it looks like it's already trying to rebound. So if the FANGs could take out their previous swing high, right, around 2,700, FANGs are going higher, NASDAQ's going higher, Dow, S&P, Equities. We're going to start the beginning phases of the melt up. We'll start making new all-time highs. I talked about oil. It gapped up and then it sold off today or yesterday as well. So it was pretty much an overreaction. I think they're going to try to keep oil prices down because it's another form of stimulus for the economy, for the U.S. at least. That's what I believe Trump's going to do. I don't like trading oil because it's highly manipulated. And not just that. I mean, you get crazy news. Things happen in the sandbox and it gets real choppy. Although, because of the high volatility in oil, it's fun to trade and it can be very profitable. I haven't been paying attention. I used to do it in the past. All right, what else am I looking at here? Here's the war stocks. What else? All right, so I'm going to talk about gold and bond market. So for a second, let's just go back before I talk about that, let's look at the S&P real quick. All right, so this is since 1971, ironically, since Nixon took us off the gold standard. Here's the S&P 500. This is phase one. Phase one, phase four. Or, if we get the melt up now, this might turn into, this entire move right here is just phase three. So this is phase one. Phase two. Now, if this entire move right here on the S&P, and all equities look the same as the S&P, if this is phase three, and the Fed all central banks around the world start printing like insanity, and they create a phase four, straight up, like almost 90 degrees, or 5,000, I mean, then I really don't hope it does this, because the crash will be horrific. But if they do this, it's kind of like it'll buy us more time, maybe years. Either way, metals will go up this entire time, and it'll buy us years to just make money. But this is scary. If they actually push the markets much higher, and you get like, it'll start looking like the Venezuelan stock market before hyperinflation. The crash will be so horrific. I mean, either way, it's going to be horrific. Although, we would have more time, and the party would keep going, although inflation will really start picking up. People would start noticing it, but they wouldn't panic because their stocks keep going higher, and they get this false wealth effect, and things stay relatively, like, businesses aren't going to completely they're not going to be going out of business left and right. It'll just, the current situation would stay the same, sort of like on Main Street, except slowly get worse because of inflation. But it would buy like maybe 3-4 more years, or 2 more years, I don't know. It would only actually probably buy just like 2 more years, something like that, because it's going to go straight up, and that takes less time. Maybe till 2023 or 2024, who knows. So obviously what I'm showing you guys here is that that hyperwave thing that rest in peace Tyler Jenks I guess coined. Although it's also, the bubble chart, the phases of the bubble chart, the Wall Street cheat sheet. So I just want to talk about that for a second. All right, let's go to gold and what I found here, what I figured out. So this is the 10-year Treasury yield, the candlesticks. And this is a daily chart. And the orange line is gold. And I see a huge pattern here, which is fairly accurate. It's pretty damn accurate. So on this daily chart, as you can see, when interest rates on the 10-year shoot up, you get a huge sell-off in gold. Or wait, that was backwards. Oops. So as you can see, the yield, when the yield drops, well, it's still true. When the yield drops on the 10-year, the interest rate, gold rallies. When the yield spikes up, gold starts selling off. Now, it doesn't always do this, but this correlation, it does it most of the time. It doesn't always do this. What I'm hoping for is what's gonna end up happening. If you guys remember in the 80s, Paul Volcker had to raise interest rates to like 20% to stop inflation in the U.S. after Nixon took the U.S. off the gold standard, right? Remove this. And I think that's going to play out again, except they're not going to raise interest rates. The free market is. And when the free market forces interest rates higher, despite what the Fed does, that's when you get the huge crash. And you could get interest rates, so the candlesticks here, going up, and then you get metals shooting up with interest rates at the same time as bonds, as the bond market pretty much blows up, and so does the equity market. And that's pretty much what happened in the late 70s and the early 80s. That was, it started off with, Black Monday. That's when the whatchamacallit brothers cornered the silver market, and precious metals went up like 2,000%. Gold did. It went up from like gold went up from like $5 to. Oh, that's not right. Sorry, I was looking at interest rates. It went from like $100 to $821. So 800% increase in the price of gold alone. So can you imagine how much the mining stocks went up? Like 100x more. All right, so that's what I'm hoping for. So I'm pretty much going to leave it at that. In the private group, I put on a position last Friday on I went bullish. I trade metals ETFs. I just hold the stocks long. I don't trade those unless I have a huge position in one. But it's pretty evenly spread out. I have enough capital allocated, risk capital, to trade the ETFs. So all I do is just hold the mining stocks. Okay, the gold, silver mining stocks. Personally, that's what I'm doing. And then I take profits from my trades, and then I'll buy physical, and then I'll buy more mining stocks for long-term hold. So I went long Friday. I added to the position Monday, and you can see that the metals market's holding up pretty well right now, above 1,500 for gold. And I think the smart money is anticipating a possible increase in metals prices again for this week after the Fed minutes. But you never know. It is kind of risky. We'll see. And I'll keep you guys updated because these next few weeks are going to be extremely crucial to the price of gold. Because, we might get this week to go higher, right? But, there's going to be a correction. There's a high possibility if we do shoot back up, take out the previous high of 1570 pretty much, or 1567. That was the high in gold last week. But if we go up into the 1600s, maybe even touch 1700 or go into 1700s, we're really close to the previous all-time high. And that means it's a bit overextended to the upside. And then we'll get possibly a huge correction going into the fourth quarter of 2019 around Christmas. And I'm actually completely fine with that. I'm okay with that. Because that means going into 2020, the price is going to have a huge correction, and we'll get one more big opportunity to accumulate more mining stocks. And if we take out the previous high and the price starts rallying up into the 1617s, I'm going to take profits even possibly on some of my longer term holds. We'll see, unless things get really crazy. And because you have to remember, cracks in the global economy started cracking, honestly, back around 2015 and 16. And the cracks have been growing larger and larger ever since then. But now with the repo news and, with the Fed having to cut rates, with stock market at near all-time highs, this is absolutely not normal. It's insane. So what this tells me is anything could happen, and metals could just keep rallying and rallying. I don't know. Nobody really knows. I'm just warning you that we might get a huge correction if the price goes up this week and next week. Let's take a look at the weekly chart. It's a little difficult right now. So, also, I mean, metals might sell off depending on the Fed, what Powell says during the FOMC tomorrow. So this is sort of a risky trade. Tomorrow's going to be a big day. I might go live. All right, guys, I'll probably go live. And, you know, we'll watch it live and I'll trade live. So stay tuned for that if you don't have a day job tomorrow. The Fed minutes, I believe it starts at 2. It usually starts at 2. Alright guys, smash some likes, leave anything in the comment section, and please share my videos. It's the only way my channel grows, and I will continue to do this. And I'll answer your comments or questions in the comment section. Smash some likes.